Hello and welcome to a new video on the Easy Finance channel. Everyone always talks about equity or return on equity when it comes to the financial situation of companies. But what do these terms actually mean and how are they calculated? You will learn all that in the next 10 minutes in this video, so stay tuned. First, a quick refresher. The accounting formula. As discussed in other videos, it is the foundation of accounting. It states that assets equal liabilities plus equity, meaning that the left side describes the assets that the company owns and the right side describes how these assets are financed, either with borrowed capital, for example from banks, which would then be the liabilities, or with our own capital, which would then be the equity. If we rearrange the formula, we can easily see that the assets minus liabilities equals the equity. Here's a small example to help you understand. This is Josh. Josh has just got married and now wants to have children with his wife. To have enough space, Josh wants to buy a house. The house costs a total of 300k, including all costs. Josh has 100k in his bank account and borrows the remaining 200k from the bank. In Josh's case, the accounting formula would look like this. After the purchase, Josh has 300k in assets, which is financed with 200k of liabilities from the bank and 100k in equity. Okay, so now we know what equity is, but let's break it down in the different pieces you might see on a balance sheet. The first is common stock. This is basically the face value of all the shares the company has issued. Think of it like the official price tag printed on the shares when they were first created, not what they are worth today on the market. Next, we have additional paid-in capital. This is the extra amount investors paid for those shares above their face value. For example, if a share's face value is $1 but investors paid $10 for it, the extra $9 goes into this account. It's like the bonus money the company gets when it first sells its stocks. Then there's retained earnings. These are the profits the company decided to keep and reinvest instead of paying them out as dividends to the shareholders. Retained earnings can be used for things like expanding the business, paying off debt, or building up cash reserves. Over time, this can become a big part of a company's equity, especially if the company is profitable year after year. Finally, there's treasury stock. This is stock the company has bought back from investors. When a company buys back its own shares, those shares are no longer considered outstanding, and their cost gets subtracted from total equity. So in short, common stock is the basic share value. Additional paid-in capital is the extra investors paid. Retained earnings is the profit the company kept, and treasury stock is shares the company repurchased, which reduces equity. Now, here's where things get interesting. There's more than one way to measure equity. The first way is book value. This is the value of equity according to the company's balance sheet. It's based purely on accounting records, assets minus liabilities, using the numbers from the financial statements. It's kind of like the official record version of equity. The second version is market value, sometimes called market capitalization. This is what the stock market thinks the company's equity is worth. It's calculated by taking the current share price and multiplying by the total numbers of shares outstanding. This number can be much higher or much lower than the book value. But why is there a difference? Because market value reflects investors' expectations, the future growth potential, and sometimes just hype. For example, a fast-growing tech startup might have a small book value on paper, but investors believe it's worth billions because of its future potential. On the flip side, a struggling company might have high book value, but a low market value because investors have lost confidence in the company. So remember, book value equals accounting reality, and market value equals investors' perception. Sometimes equity can even go negative, and that's a red flag. Negative equity means the company's liabilities are greater than its assets. In simple terms, the company owes more than it owns. This can happen if a business has been losing money for a long time, takes on too much debt, or its assets lose value. Here's a quick example. If a company has 500k in assets but 600k in liabilities, the equity is negative 100k. That means if the business sold everything, it still couldn't fully pay off its debt. Negative equity doesn't always mean bankruptcy right away, but it's definitely a warning sign that the company's financial health is in trouble. Investors usually avoid companies in this situation unless they believe there's a chance for a big turnaround. Equity isn't just about how much ownership exists, it's also a total measure of performance. That's where return on equity comes in. Return on equity shows how much profit a company generates for every dollar of equity. It's calculated by dividing net income by shareholders' equity. For example, if a company makes 200k in profit and has 1 million in equity, its return on equity is 20%. A high return on equity usually means that the company is using the equity effective and generate profit with it. But there's a catch. Sometimes a high return on equity can be the result of taking on too much debt, which reduces the equity then and makes the ratio look better than it really is. That's why you should always look at other ratios as well and not only on return on equity to get the full picture. Equity is also a key part of valuation models, which are used to figure out what company is worth today. One of the most popular is the discounted cash flow model, or DCF for short. The DCF estimates the present value of all the money a company will make in the future, adjusted for risk. From there, we can work out how much of that value belongs to the equity holders after paying off any debt. There are also other models, but this is the most famous one. In every case, understanding equity is essential because it's a piece of the value pie that actually belongs to the owners. Here's something important. Equity isn't just a number, it comes with ownership rights. If you own equity in a company, you own a share of that business. That means if the company is sold, you're entitled to your portion of what's left after debts are paid. You might also get voting rights on key business decisions like electing the board of directors or approving major changes. For example, if you own 10% of a company's equity, you essentially own 10% of the company and 10% of its profits after obligations are met. That's why investors care so much about equity, because it's their stake in the business. Alright, that was a lot. Let's wrap this up with a quick recap. Equity equals assets minus liabilities. It's what's truly yours after debts are paid. It shows ownership in a company. There's book value from accounting and market value based on investors' opinion. The equity also can go negative if liabilities are higher than assets. The return on equity tells you how effectively a company uses its equity to generate profits. And in valuation, equity is the part of the company's value that belongs to the owners. So, equity is more than just a number. It's a foundation of ownership and the key to understanding a company's financial health. And that's equity explained, simple, clear and practical. If you found this helpful, don't forget to follow Easy Finance for more quick and clear tips on finance, accounting and investing. The more you understand, the smarter your money decisions will be. Thanks for watching and I'll see you in the next one. Bye bye.